Good afternoon to everyone, and welcome to the panel discussion on Analysts Take Dividend Portfolio. I'm Hazel, the Chief Trainer of the Joyful Investors, and I'm the moderator for this panel discussion. So dividend stocks, they play a very essential role in our investment portfolio, and they also provide a steady income stream, reduce the overall portfolio volatility, as well as offer potential capital appreciation for investors. So in this panel discussion, we are going to explore the relevance as well as potential for Singapore's small and mid-cap stocks, dividend stocks in our dividend portfolio towards building an additional stream of income for ourselves. So let's welcome our esteemed panelists to shed light on these crucial investment insights. Today we have with us Paul Chew, Head of Research from Phillips Securities, and Dale Lai, Equity Research Analyst from DBS Bank. Without further ado, let's start off with a round of introduction from our panelists. Over to you, Dale and Paul.
Is Dale going to stop?
Dale, we are unable to hear you.
Can you now?
Yes, you are.
Yep.
Right now it's fine.
Yep. Okay. Sorry. Yep. So thank you once again for having us on the panel today this afternoon. As Hazel mentioned, I think the topic today is talking about dividend portfolio, dividend stocks. And for myself, I am covering the REITs and property sector in DBS, doing equity research. So basically under our coverage, we look at some of the listed REITs in Singapore, as well as listed property developers. And yes, I think as we all know, for REITs, dividend is something that's really important, something that we keep a close eye on. So yeah, hope to shed more light and discuss more on this today. Yeah, thanks.
Okay, thanks, Dale. So I'm Paul Chew from Head of Research at Phillips Securities. So I cover consumer, healthcare, telcos, strategies, electronics, some small and mid-cap stocks. So our general take on dividends now is especially pertinent, especially for small mid-caps, because you're no longer getting a return from the market. So you need to also consider the return from the company. So it can be dividends or stock buybacks, or it's off the table. So in a nutshell, you can't, because these days most of the liquidity goes to the US. So as a result, you can't expect the market or basically strangers to give you returns. So you really need to get it from the company. So that is the phenomena for small mid caps, not just in Singapore, but I think globally that we think is the situation.
All right, so as we begin, let's first delve into understanding how investors can go about looking at the selection of dividend stocks. So what is the strategy and criteria for selecting small and mid-cap stocks with sustainable dividend growth, as well as financial stability? And are there any sector-specific considerations that will influence your selection of dividend stocks? Let's hear from Dale first.
Okay, thanks, Hazel. Just confirming, you can hear me again, right?
Yes, right, can hear.
Okay. So as mentioned, my specialty is in the Singapore REIT. So I would say my presentation, my discussions today will revolve around REITs. So I think firstly in terms of the selection criteria, what we look out for in REITs, I would say first off financial metrics, the earnings stability, growth prospects. This would be very important, especially in a time now where the interest rates are expected to remain elevated. How this would affect the financial metrics for REITs, especially in terms of financing their debt, refinancing, and then their leverage ratios. Secondly, I would say what would also be important is in terms of looking at management track record, in terms of management strategy, in terms of management ambitions on how they want to grow the REIT, as well as what are the tools they are using to tackle current things like geopolitical tension, things like rising interest rates. That would also give us a very good idea of what would the REIT do and how would they tackle some of these issues. Thirdly, and not the last, I would say, especially for small and mid-cap REITs, looking at the support from sponsors, support from parents, that would be very, very important. It would be important for all REITs, but more so for small mid-cap names. More important, because given their smaller market cap, given the smaller investor following, a lot of times they require support commitment from the sponsor. When it comes to things like acquisitions, how would the sponsor support their growth? Even when it comes to certain things like managing some of the risks that they are faced with. So I would say the third thing that is important, especially for small mid cap REITs, would be looking at the support from sponsor, who the sponsors are, what have they done so far. Looking at sector preference, I would say across the board. If you look on the chart on the left, that is what we call the current property clock. Looking at the various subsectors within real estate, within REITs, where are these subsectors at right now, and how much further do we expect them to grow, or are they in the contractionary phase? If I delve specifically into all of these subsegments, I would say at this point in time, for us in DBS, our preference would be retail and industrial. These two segments. So, for example, for retail, I think especially if you look at suburban malls, suburban segment, they are still benefiting from this change in consumer behavior, this work from home trend. If we go into industrial, I think specifically we look at logistics, warehousing, that is benefiting from e-commerce and this supply chain, and as well as for example data centers, the tailwinds there. Next off, I would say that hotels. We also like hotels, mainly because Singapore is still going through this recovery from tourism, and we think that the upscale and economy segment within the hotels sector would outperform. And last but not least, if we look at office, I think that we would be very selective there. We are somewhat neutral on the office segment right now. But within office, for example, grade A, we think that they will continue to outperform. Most importantly, due to the limited supply in our central, our core CBD. And I think, for example, for the grade B officers, those that are not as well located, that is the segment that we would be a little bit more cautious on at this point in time. So I would say that is our so-called ranking, in terms of performance for the various sub-segments. Yeah. So maybe I'll pass it back to Hazel or to Paul to share views.
What about Paul?
Yeah, thanks, dear. So for small mid-cap dividends, firstly, why go all the way down to a small mid-cap? So usually small mid-cap, you buy if you have growth. In the Singapore context, you need at least 40-50%, virtually 40-50% earnings growth. The reason why I say that is because if you look at like the Magnificent Seven, their earnings growth is almost 50%. You take out Nvidia, the latest results, they're growing about 30%. So if I want to buy growth, if it's a small mid cap that's growing 10-15%, do I really need to go and buy a small cap? I can just go to the US, more liquid, big names, easy to understand Facebook. I'm not going to crack my head to try and find out what's your business model. So when it comes to dividends, in terms of the checklist again, the key is of course dividend sustainability, and this is virtually a checklist that we use. It's basically all cash. So the first checklist that we use is you need to have cash on the balance sheet. You can pay a one-off, but then the market will just adjust back down. In return, you get nothing. So firstly, we look at how much cash they have in the balance sheet. And assuming they pay 20 million, that's picking a number, how much cover can they get? Maybe they have 100 million in the balance sheet. So even if 1 year earnings may be down, they can still sustain it because they have enough cash and they're not gearing up. Because if you gear up, obviously it's not sustainable. Second thing is the business model. Is this a very heavy capex business model? Even if it is, then is it past the heavy capex cycle? And of course, some business model that we'll discuss later, some companies virtually don't have any capital. The balance sheet is probably 5 computers and probably one office building, one office lot, not on a building. The fixed assets could be only 2 million, and that's it. They don't need to inject capital. So the good part about this is they are always spewing out cash. So you virtually don't have to inject anything. The third one is, of course, willingness to pay. Some companies, as you quite familiar, I won't mention names, Papa, but I won't mention names because it's not right. But these companies can virtually hoard a lot of cash and they just don't pay. Of course, they'll tell you every year they're going to pay, they're going to invest, but nothing happens. So the third criteria is, of course, willingness. And the fourth is just the volatility. Because even though the business model is great, balance sheet, all that, the fourth is whether is the earnings in structural decline. So, or are they in some? Is just a volatile downturn and they can recover back? No, because most companies will ride one cycle or another. So this is just a general checklist that we use, which probably we can discuss when we go more company specific. Thanks.
Thank you, Paul and Dale, for sharing on your selection criteria for looking at small and mid-cap dividend stocks in Singapore. So, moving on, in terms of the benefits of building up a dividend portfolio, how does having a dividend portfolio help to manage risk, particularly in relation to dividend cuts, economic downturns that we may face upcoming? And what are some of the advantages of investing in a dividend portfolio versus other types of income strategies? So what are your views on this, Dale?
Okay, thanks, Hazel. So I'll answer this in two parts. I think firstly, why look at dividend stocks. I think firstly in terms of stocks, share price movement, share price performance, that is definitely always the most important. But in addition to that, REITs give a additional layer of returns, which comes in the form of dividends. So again, like I mentioned, that is something that is one of the most important factors for REITs that we are always keeping track of. So if we just look at in terms of how the Singapore REITs have been doing, I think we all know that Singapore REITs have been undergoing a little bit of a correction over the past I would say 12 to 18 months in relation to the higher interest rates and environment. So with some of this correction in REITs, right now Singapore REITs are giving you a dividend of, I would say, between 6.5% to 7%. If we compare this to the historical average, I would say we are in the very attractive range, above historical average. And if we look at it across the region, Singapore REITs typically generate or typically give a significantly higher dividend yield as compared to some of our peers in neighboring countries. If you look at the chart on the top, I think aside from Hong Kong, which actually went through a larger correction due to concerns in China and Hong Kong, if we put that aside, I think Singapore REITs are currently one of the highest yielding REITs in the region. Secondly, I think if we look at REIT as a alternative dividend generator, a lot of times REITs are compared against some of the other dividend generating kind of instruments. More importantly, if we look at REITs versus the likes of our STI index, or even if we look at REITs versus the government bonds, REITs are currently giving you a dividend yield of almost double of what they are giving. And I think in recent times, REITs have been compared to the Singapore banks. We all know that our Singapore banks have been giving very attractive dividends over the past few years. And right now, the Singapore banks are on average giving you a yield of about 6%. So we have a lot of questions, a lot of clients asking, why invest in REITs, when banks are giving us 6%. I think this is a good argument, but one thing to understand here is that banks go through they are actually a very cyclical stock. They go through cycles, economic cycles. Their share price, their performance, their dividends follow very closely with the economic conditions. So I think right now it's good times for banks with high interest rates, and that's why they are giving you very attractive dividends, recording very healthy profits. But if you look at REITs, I would say in terms of earnings, in terms of dividend payments, they are more stable. I think most importantly, REITs are expected to give out at least 90% of their profits. Many times they give out up to 100% of all their profits. So in that sense, whatever profits they generate, they give out as dividends. So I would say in that sense, their dividend payments are more stable. And I think more importantly, if you look at it inherently for REITs, right, the underlying business is really from rentals that they collect from their leases. Rentals typically range from 3 years to 5 years to as long as 7-10 years. So this also helps to provide another layer of I would say income stability. So yeah, so I think at this point in time, we think that yes, although REITs are expected to go through a little bit more of volatility in the markets, but dividend yields are something that we should always keep track of when we look at the total returns for REITs as a whole. Yeah.
How about for Paul? What are your views on this?
Yeah, thanks. So basically, this is a chart. Sorry, it's a bit small. But so this is just a chart of 3 stocks that we cover that provide very high yields and they meet our so-called the 4 checklists, because it's very difficult to meet those checklists. But essentially, what you see here are the stocks like Propnex, HRNet, and Valuetronics. So I didn't think it's not just about 1 year of dividends, because if you're playing this dividend yield game, it's about the cumulative. It's about cumulative dividend yield. So from what you can see here is that they continue to pay good dividends, about maybe 5-6% or more. And you notice, let's say take Propnex for one. You'll notice that the cumulative dividends is as much as that will lower your cost. If you can read the words here, it's about almost 50, if I'm getting this right, so 58 cents. So basically, technically, you're getting a yield, and you also help to de-risk your share price. So although the share price are trading at 80 cents, but you're collected enough yield to bring down your cost. So it's one way to also de-risk the portfolio. But having said that, this is a long game. So these are dividends collected over many years. This is not, if you have a 1 year horizon, then naturally dividend yield is not for you, because the share price can just drop 5% and you just collect it. So all your dividends just disappear. So if you're playing that long game and you like that yield, and you're essentially, what you're doing is that you're buying into the economics of the business. You're not buying into the volatility. Like Propnex, it's very volatile because it's very dependent on the volume. But you like the economics because they got like 40-50% market share. Virtually any property unit that is sold, someone have to pay them a commission or some royalty. I mean, another way to frame it. So if you move on to HRNet, so this is another company that pays out lots of cash, and they paid out almost 200 million of cash for small cap. So half of the market cap is virtually all cash. And you are not only judge it on the dividends that they paid for 1 year, they've been continuously paying and returning so much cash to them. So it's kind of, and the business model is great because there's hardly any fixed assets. Probably 1 car for the chairman, which no, I think it's probably only 1-2 million. So but even with that, they can generate almost 50-60 million kind of operating cash flow a year, and they have a 300 million cash, 300 million balance sheet. So that gives you comfort that even if cyclically is down, they will still can pay the high dividends. And the fourth one, just to do very quickly, is also Valuetronics. That one's a bit more unique because you're doing electronics, so it can tend to be a bit more volatile, but the businesses that they're in is a bit more stable, and almost 80% of the balance sheet is in cash. So they pay about, and they have about almost 200 million of cash. So in a nutshell, we just want to show that it's the cumulative part. So this is only the last 5 years. So if you want to extrapolate, rightly or wrongly, your cost will probably come down by another 30-40%, and you kind of de-risk yourself, because anything goes wrong, I mean, touch wood, your cost is probably only 50% of the current share price. So that's another way to look at dividend yields, but it's not for everyone, because not everyone has the patience. Not everyone just want to make. No one just want to get. Why not, right? You can get rich tomorrow. Why wait for 5 years? But if you want that yield, you want your strategy is just to buy the economics of business. It will go up and down because there are cycles, but That's the conclusion of it. Thanks.
Okay. Could you also share with us, in terms of the performance of the Singapore small and mid cap stocks, how do you think it will likely compare to the other blue chips in terms of dividend payouts? And moving forward, what trends do you foresee in the dividend stock market in Singapore over the next 5 to 10 years? How would Singapore dividend stocks compare to those in other markets, right, such as in the US, other regions, and so on, in terms of yield and stability? What are your views on this deal?
Okay, thanks, Hazel. So again, the focus here is on Singapore REITs. And over here, I would use the example of the Singapore industrial REIT segment as an example. Main reason being that the industrial REIT segment is one of the most diversified subsector with the most names. So it's easy to compare between the large caps versus, I would say, the small mid cap names. I think two of the main indicators that we track are the likes of your price to book ratio, as well as, again, dividend yield. So what it means and what we should be expecting here. So if we go through the one at the top in terms of price to book ratio, historically there has always been a spread, a difference between the price to book ratios of your large caps versus your mid caps. The spread has been about 0.24 times, meaning to say that historically your industrial large caps have been trading at a slight premium to book. Whereas if you compare to your industrial mid caps, they have been trading slightly below book. I think main reason here, being that the investors' preference, they are willing to pay a higher price for something that they deem as, I would say, more stable, longer track record, versus some of the inherent risk in a smaller mid cap name. So I think right now, in terms of the spread between the price to book ratios for large cap, mid caps, it's close to the average at about 0.23 times. Then I would say the next thing that we look into would be in terms of the dividend yield spreads. So again, historically, the dividend yields of industrial mid caps have been higher than your large caps. Again, because of the perceived inherent risk for the smaller cap names, investors demand a so-called premium in terms of yields for your mid caps, small caps versus your large caps. Right now, if you look at this spread, your mid caps are giving you a spread that is as much as 1.7% higher than what your large caps are generating. So I would say at this point in time, the mid caps, small caps are starting to look a bit more attractive. We're seeing a bit more value there. As much as, yes, there is a lot of volatility, uncertainties in the market, we think that starting to look at some of the small mid caps, especially those that I mentioned earlier. If you look at the three criteria in terms of their financial matrix, their management track record, and the support from sponsors, those that are a bit more fares a bit better in these three categories, I would say these are some of the names that we should be looking into. In terms of trends, what should we expect in the near to long term? I think we all know that companies, especially for REITs, have been quite negatively impacted by the high financing cost. And I think this trend is expected to continue at least until the end of this year. Even with interest rate cuts likely to come towards the end of this year, I think there is a bit of a lagging effect. We should expect to see REITs still reporting a bit more high spike in their borrowing cost. Then come probably next year, early to mid next year, I think we will start to see a sort of a bottoming out, a reversal in terms of the earnings for REITs. We should start to see them coming back. Then I would say naturally we would see the large cap names start to run first, followed by I think the mid small cap names will start to catch up thereafter. So yeah, I think in general that is what we are viewing. And I think for us, we always view this as being early, being ahead of the curve, entering the market, positioning yourself before the rate cuts actually happen, will actually generate you a alpha that I would say it's helps you outperform the market. Yeah. So yeah, maybe I'll pass on to Paul.
Okay, so I'm not as hardworking as Dale, so I didn't have any slide. But for large cap, I mean the obvious thing is that to buy a mid cap for dividends it really has the type, not to sound corny, but you really have to be a gem, because not many small caps have such a strong balance sheet. So the one difference is that most large caps actually do gear up the balance sheet. Even a bank, if you look at it, 5 or 6% yield, technically they are also geared, because deposits is another type of borrowings, but you just call it as deposits. I know it sounds nicer, but so the one advantage is that some of the small mid caps names, they have a stronger balance sheet on paper because they are technically all net cash. Probably the only other large caps probably like venture that has like, I don't know, 1 billion of cash. So that is one advantage I guess mid cap have. They have a better balance sheet. And the other thing is, the second one is probably they have a more flexibility in the payout ratios. So most large caps kind of cement their payout ratios, especially banks, maybe like 50%. I'm using banks because banks is the hurdle rate. I mean, if you don't have a yield better than a bank, then what's the point? So, but for a lot of small mid caps, they pay special. Their payout ratios can be even 80, 90%. Because again, the key thing is they continue to generate a lot of cash. So they're just every year they're just producing lots of cash. So that's why they can produce such a good returns. Then what trends we foresee? Not, I don't think there's any particular trend. The only trend is if growth can come back, then maybe there'll be more. The swing will go to small mid caps, because right now most of the premium valuations all go to large caps. Whereas if you dial back maybe 15, 20 years ago, small caps were the ones that had better valuations than the mid caps. So unless you get some growth spurt, then that will be the swing you need to monitor. Yeah.
Okay, so we'll now take some questions from the audience as well. There's a first question to Dale on REITs. So MAS proposing 1.5 times ICR for all REITs. How will this affect REITs' ability to maintain high dividend payments going forward? What's your take on this, Dale?
Okay, thanks, Hazel. Yes, so with regards to this, I would say that I think this is definitely we see it as a positive for the REIT. I think the regulators, MAS specifically, has recognized that maybe they were a bit too stringent on this clause previously. Main reason being that I think with interest rates spiking so much in such a short period in time, has inevitably led to a little bit of stress on the balance sheets of some of the REITs. So I would say that as much as they have lowered this gearing criteria, we don't expect to see any significant changes in terms of the REITs balance sheet, the balance sheet mix, how they look at debt. So I think overall I would say it's a positive in terms of giving them more flexibility to manage their balance sheet. But yet at the same time, I don't think this will cause too much changes within the entire REIT sector.
Okay, thank you, Liu. There's a question, to Paul. What advice would you give to new investors looking to start building up their dividend portfolios?
I think just buy a course. Don't just buy virtually an ETF, because I doubt most investors have time to select, to kind of pick and choose. Even us analysts who dedicate all our time also get it wrong. So I mean, if you don't have the time, just buy like an ETF, buy across a dividend specific thing, because the dividend is probably the purest return you get. You don't have to depend on the market doing well, strangers agreeing with your call that this stock is doing well. Sorry, I know time short, so let me just end.
Okay, so maybe just one last question. What are your predictions for the performance of dividend portfolios compared to growth and value portfolios in the upcoming year? Dale, what are your thoughts on this?
Okay, I hope that I am good at doing predictions. Help my own personal as well. But okay, I think in terms of the trends, personally, what I expect to see is, I think at least for now, there would be some emphasis on dividends going forward. Giving you that stability. But once we see that turn, once we see more positivity in the market, once we see, that interest rates have stabilized and start to come off, I think, then everyone will crowd towards, where are the value stocks? How do I gain that alpha? So I would say that dividend stocks would always be favored, but maybe the focus will shift more to value stocks, as the interest rates peak and then start to come off.
All right. So thank you very much for panelists on your very insightful discussion that you guys have shared in this panel discussion on the topic of dividend portfolio. And we hope that this discussion has also provided a lot of valuable insights and food for thoughts for our attendees. So thank you for joining us today, and do stay around because coming up next is the lucky draw. So I'll pass the time over to Nigel.
Thank you very much, Hazel, Paul, and Dale, for that very, very insightful sessions. And we hope that everyone else has a great learning session across with all the industry leaders. So yeah, ladies and gentlemen, we have come to one of the most exciting segments for today, our very first lucky draw. So in total, we have a total of 12 prizes to give out, and we'll now draw 3 lucky winners first, who will each win a $50 Star Hill Global Shopping Voucher, sponsored by Securities Investors Association of Singapore, SIAS. Okay, and we'll do the first draw. Congratulations to Maria Tang for being the very first winner for this shopping voucher. And next up, we'll draw the second winner. Congratulations to Mr. Richard Tan for being the second winner. And right now, for the third winner for the Star Hill Global Shopping Voucher. And congratulations to Tan Mi Chu for being the third winner for this segment itself. Next, we will now draw 3 lucky winners who will each win a 1-month free Web Pro usage, sponsored by Share Investor. Congratulations to Yak Yong Kui for being the first winner for our Share Investor Web Pro prize. And we'll now proceed on to draw the second winner. Okay, congratulations to Chloe. I would think that you should be more or less a lady. We'll reach out to you via your email as well as your mobile number. And we'll now draw the third winner. Congratulations to Alams Ja. We'll continue to reach out to you via the email as well as the mobile number that you used to register for SG Gems today. Next, we will now draw 3 lucky winners who will each win a Bank of America share, proudly sponsored to you by Philips Securities. Congratulations to Arun Kumar Sudaram. Yes, yeah. I hope I pronounced the name correctly. And we'll now proceed on to draw the second winner. Congratulations to Mr. Edmund Tan for being the second winner for this prize. And right now we'll draw the third winner. Congratulations to Miss Rachel Yao for being the third winner for the Bank of America share. And finally, we'll now draw 3 lucky winners who will each win a $50 Fair Price voucher sponsored by CGS International. Congratulations to Lim Chi Hien for being the first winner for the Fair Price voucher. We'll now proceed on to draw the second winner. Congratulations to Alvin Lin for the second winner for this Fair Price voucher prize. And we'll draw the third winner for today. Congratulations to Clifton Hunt for being the third winner for the first lucky draw segment. Yeah. So congratulations to all the winners, and we'll reach out to you soon via your email as well as your mobile number, which you had used to register for this event. And to everyone else, we will have a second lucky draw at the end of the event itself with many more exciting giveaways. So continue to watch the sessions, and who knows, you'll be the next lucky winner. Next, we will have a discussion on analysts' take on high conviction portfolio with Charmaine Tan of IFA Singapore, John Chuang of UOB Kay Hian, and moderated by Hazel Soon of the Joyful Investors. To watch the discussion, head over to the program tab on SGGEM's website and click on the watch live button that is beside the session. We'll see you there.